Everyone's watching America blow its budget with trillion-dollar tax cuts and dreamy debt ceilings. But the real fire may have started elsewhere, under the floorboards of Japan's bond market. The long end of their yield curve, once the safest corner of global finance, is now in free fall. And Japan's biggest bondholders, life insurers, aren't just sitting on losses. They're dumping 30- and 40-year paper at record pace. The official story? Don't worry, these are just paper losses, we'll hold to maturity. The reality? A regulatory shift rewrote the rules, the liability math collapsed, and now insurers are caught in a duration mismatch so brutal it makes Silicon Valley Bank look like a warm-up act. Why does this matter outside Tokyo? Because these insurers aren't just in Japanese government bonds, they're whales in US and European bonds too. If solvency ratios break, the forced selling won't stay local. It'll ripple through every yield-hunting market. This isn't about Japan being weird. It's about what happens when even the most patient capital says, enough. The Bank of Japan is trying to stabilize things with more bond buying. But it already owns half the market, so adding more is like handing your rich uncle a bucket after the house has burned down. Worse, it turns into a game of chicken. Will insurers keep selling until the BOJ panics? Or will the BOJ hold back and risk triggering an insolvency spiral? Meanwhile, across the Pacific, bond vigilantes smell blood. With deficits ballooning and no fiscal discipline in sight, they're bidding up long-end US yields in protest. The parallel is eerie. In both countries, markets are losing faith in their government's ability to manage debt and pushing rates higher to prove the point. This may be a slow-moving crisis. But slow-moving doesn't mean safe. It means pressure builds quietly, until, suddenly, it doesn't.